Talk. Thanks for joining us again for the Playing the Long Game series. Here with Drew Casey, CFP, Grant Williams, CFP here alongside Drew. Good morning.
Good morning.
It is the morning, isn't it? Still
Just barely.
11:30. We're talking about a topic today that is of particular interest to us here. We spend a lot of time on this topic with new clients specifically and existing clients whenever we're kind of retooling their portfolio, engaging in some rebalancing. We call this asset location.
Mm-hmm. Bit of a play on words there with asset allocation.
Thank you. Yes.
Maybe you could call this a subcategory of planning.
It's not a spinoff, but it's there.
It's underneath. Yeah.
But it's really important. And Drew, maybe just in 4 sentences or less, kind of give us an executive summary of what asset location is and what we mean by that.
Yeah, absolutely. Asset allocation, we typically talk about, that might be someone deciding that they're going to have a 60-40 portfolio, 60% in equities, 40% fixed income, something like that, some sort of split between asset classes there. Asset location is specifically zooming in and saying, okay, if we're going to have 60% equities, what kind of account should hold those equities? What's most optimal to have fixed income in terms of a tax bucket and account type? And so it's really drilling in beyond the overall split of 60-40 or 50-50 is kind of the example we're going to talk about today, and saying, okay, is there an optimal way to split these assets up between tax types, different account types, to produce a better outcome?
Where do I want to hold my stuff?
Exactly.
Exactly. And our goal today is to give you kind of a simplified example, just to sort of kind of set the table, to get you ready for maybe a little more in-depth conversation on this topic. And we're going to prep something that's really a more down in the weeds illustrative example in a second video. So today we just want to kind of prime the pump, so to speak, and we're going through it very simply and quickly. And then if you're listening on, of course, our 5 monthly listeners,
yes,
they
will benefit.
They will benefit.
Yes.
So we've got kind of a chart here, not really a chart, but just a graph of 2 buckets.
Yeah.
A graphic of 2 buckets. And Drew, just explain what we're looking at here.
Yeah, it's very typical. A client will come in, they've got some portion of their money in an after-tax brokerage type account and some portion of their money in a pre-tax, an IRA bucket of some kind. And so, someone will say, well, I have a 50-50 asset allocation maybe. It would be somewhat logical to think, well, my after-tax bucket is going to be 50-50 and my pre-tax bucket is going to be 50-50, right? Wouldn't that make sense? You want them to be proportioned accordingly. You want them to perform the same. And that's where we get an opportunity to actually step in and maybe change some things.
I'm going to come in here with a little bit of a stronger hand.
Please do.
If you'll allow me to do it. And I'm going to get on a soapbox. When we're onboarding a new client at our firm, I cannot even begin to tell our listeners how common this is. I would say in 7 or 8 out of 10 portfolios that we onboard from a previous advisor that they've had, they look somewhat like this. In other words, every account is the same in terms of asset allocation.
Maybe boilerplate, broad application of some investment policy.
It is typically with, and again, not trying to be a salesman here, but it is typically with big institutions that have a lot of scale and they can't do anything really bespoke in client portfolios. Every account really has to be the same because that's the easiest way to manage it. They have billions and billions and billions of dollars and thousands or hundreds of thousands of clients. And it's really a disservice. And I would almost say it's a reason you want to really vet your advisor on some specific questions. Make sure they have the capacity and the ability to tailor solutions directly to you. It's really a problem in our industry. I would stick my neck out that far to say.
Well, it's an indication that maybe the portfolio is not getting the attention it deserves.
Absolutely.
Absolutely. Yeah, it's not being cared for.
Eloquently put. Yeah. And you're going to go through a couple of reasons why this matters so much.
Yeah, and the reason we even think about this in the first place, so reasons that asset location is important, makes a significant difference to ending portfolio value. We're going to show you some numbers today. Again, simplified, but they will kind of illustrate that point. If you think about a pre-tax, IRA bucket, for example, that entire bucket is either now or one day in the future going to be subject to ordinary income tax rates, compared to a brokerage account, which is subject to most often qualified dividends, maybe long-term capital gains rates. And so there's a huge imbalance in the tax treatment of those two buckets, which plays into this conversation.
Capital gains, qualified dividends are favorable
Exactly.
compared to most people's ordinary income tax bracket in retirement.
If someone has fixed income in an after-tax brokerage account and it's not tax-free municipal, they're getting ordinary income hitting their tax return every single year. That's outside of their control. You don't have that if those assets are in a pre-tax IRA. And so, pre-tax assets one day will be subject to required minimum distributions. At some age, 73 for many of our clients now, 75 for younger clients. The IRS says you've got to take out a percentage of those assets every single year. And so the size of that account makes a big difference, when that day comes.
Step up in basis is also big. That's kind of a long run thing, but
Exactly.
talk about that for a sec.
Well, an after-tax brokerage account, if that is let's say we're going to jump ahead a little bit. Let's say we have all equities in an after-tax brokerage account. We want that account to grow as much as possible. The reason is for the second generation inheriting these assets, at the first generation's death, those assets will receive a step up in basis. And so all the capital gain tax liability that they're exposed to there is kind of wiped clean under the current legislation. So that's obviously very tax optimal to let those assets grow as much as possible. So, we've got a second slide here that will show very simplified example. Of course, it depends on the client circumstances. But we, at a default kind of baseline level, we'd say, okay, we want equities in blue there to be, kind of focused on the after-tax side of things for the reasons we just talked about. And we want fixed income to be as much as possible in the pre-tax bucket.
If you have a 50-50 asset allocation in this example, and you want that conservative element to your portfolio, and so that inherently means you're going to suppress return.
We want
somewhere.
Exactly. Yep.
And if you're going to suppress returns, you should do so in the bucket that has tax liability associated with it.
Exactly.
It's that simple.
Yeah.
And then there's these inherent benefits of the after-tax side, getting all the growth.
Exactly.
So no, that's a good bucket there. And then I know we've just, again, keeping it simple today, that's the focus. We're going to dive in a little deeper in a follow-up video, but I know you kind of built in a few assumptions here, Drew, to take this just kind of a little step further today.
Yeah.
You want to run through that?
Well, we're making the claim that this is more optimal, so we just wanted to show you how that plays out. So we've made some kind of broad assumptions here about this imaginary portfolio. Let's say it's starting at $1 million.
Those are, of course, you and I's portfolios, imaginary.
Yeah. Divide that by $1 million.
Sorry to interrupt you. Yeah.
Exactly. We're going to assume 5% annual growth rate on fixed income assets. And we're going to assume 10% on equities. We're going to assume a 25% ordinary income tax rate.
Yeah.
A 15% capital gain tax rate. Of course, that varies. Both of those numbers vary just depending on your tax brackets. But
keep it simple.
Keep it simple. We're going to assume these assets are invested for 30 years. And then we're going to assume liquidation of the IRA at the end of year 30. We're going to assume taxation of the equities, at long-term capital gains rates at the end of year 30. We're also assuming annual taxation of the fixed income, as that's just typically ordinary income hitting your tax return every year.
Sure.
And so, that first slide there, that's our first example. Someone comes in with an evenly balanced portfolio in both of their sort of tax buckets. The portfolio value at the end of year 30 in that case is $8.5 million, a little over that, which is pretty good. The power of compounding there. But if we look at that second slide, let's say we change the assumptions. We've got all our equities in the after-tax portfolio, all of our fixed income in the pre-tax portfolio. At the end of year 30, that portfolio is worth $9.1 million. So that's a $600,000 swing. Simply just because of where the assets are located in relation to their taxation. So,
again, it's kind of some broad sweeping assumptions here.
Yes.
Really simplified.
We're going to get dividends and turnover and all that kind of stuff.
Which all that stuff matters. But
does,
what we're doing is just trying to kind of prove a point and educate our audience and help them understand that this really does matter. It seems simple, but it really matters.
Makes a difference.
And in this follow-up video, we'll get into some more depth. For those maybe engineering and operational minds that are interested in that level of depth, we're happy to get into that. But hopefully this at least kind of sets the stage. You wanted me to kind of close with talking about Roth IRAs, perhaps. I will. Drew has allowed me very cordially to get on my selling soapbox a little bit today. This is really, I would use the word disgraceful. And that might sound a little bit strong, but I made some comments at the beginning of this pod about our competition having not thinking about asset location. And in this example, we've used an after-tax bucket, we've used an IRA bucket. We left out a big third bucket in our business, the Roth IRA.
Just for simplification, but
A lot of times we will see new clients come in and let's say they have 3 accounts and they're 50-50, kind of like our example today. Every account, including the new Roth, will be 50-50 as well. This is really bad. A Roth IRA has the longest time horizon. It should be the most aggressively invested. It's the last bucket if you're retired that you would ever want to touch because it grows tax-free, withdrawn tax-free forever. And those inherent values mean that you just want your most aggressive investments, the investments with the highest earning power and growth potential over time, to be in the Roth IRA first. And
it's the best asset really to leave to your heirs in many cases.
absolutely. That extends the time horizon out even further, which is another reason you would put equities in there. Again, I would just say if you're looking at your Roth IRA and it has bonds in it or it has conservative investments in it, it's really inappropriate in our view. And you know, if it's the only account you have, that might be an example to have some fixed income in there. But if you have any other wealth outside of a Roth IRA and you're looking at an advisor managed Roth with bonds in it, we kind of have pretty serious argument with that. So yeah, just thanks for letting me stick my neck out.
Yeah, it's important.
And, you know, be kind of crazy, of course. But
It is common shocking how often we see this.
I feel like I see it once a month. So, and then I come over to your desk and I sort of vent about it. And,
Yes,
and you typically have a way of calming me down, I find.
Sometimes.
Sometimes more than others, perhaps.
Yes.
Thank you for joining us and watching us go through these topics together. We're excited to keep developing some content and yeah, excited for part 2. It'll be good to get into the weeds and kind of highlight more of the intricacies of asset location. So thanks for joining us, Drew.
Yeah, absolutely.
Until next time, thank you so much for joining Playing the Long Game.